Hello class, this is Demetrius Wilson again with Managerial Accounting, and it's week 8. Things are moving right along. We're moving on to the next chapter, chapter 8. Lots of interesting things to talk about and discuss. So, how is capital budgeting used to make decisions? And as I always say, managerial accounting is all about making decisions, and that's why we go through each of these modules so that you as managers can learn to understand how to make decisions using this information. So apply the concept of time value of money to capital budgeting decisions. So you have to understand how much your money is truly worth today and how much your money is truly worth in the future. And some of the steps that we go through shortly will surprise some of you in regards to which one is worth more. So what is capital budgeting? Capital budgeting decisions involve analyzing and deciding what long-term investments to make. Not short-term investments, long-term investments. Speaking about purchasing buildings, purchasing large amounts of machinery, things of that nature. So some examples are San Francisco Symphony investing in new stage equipment, McDonald's investing in a new restaurant, Honda Motor Company investing in new manufacturing facilities, and Bank of America investing in new branches. All huge, big purchases. So also called capital expenditure decision. Just depends on how you word it and what you've been taught on how to phrase it. Capital budgeting involves using company funds, which is called capital, to invest in long-term assets, right? A building is a long-term asset. So why is the time value of money important to capital budgeting decisions? We'll explain why. Capital budgeting decisions are long-term decisions that affect future years. To make good capital budgeting decisions, we must consider the time value of money. How much is that money that we're investing truly worth, and is there a better option that we can invest in? The time value of money concept recognizes that the money is worth more today than in the future, and that's a definite, right? So if you have $1,000 today, it's worth more than $1,000 3 years from now because you have the option to invest that $1,000 somehow, some way. Because if we had the money today, we could invest it and earn additional money. The time value of money begins with the concept of future value. And here's an example. And I like how the PowerPoint also goes along with the examples in the book, so it's really easy to follow. So if you're looking at the book at the same time you're looking at the PowerPoint, you'll see exactly where the numbers are coming from and where we're getting this information. If you invest $1,000 today at an interest rate of 5%, and remember in decimal form that's shown as 0.05, how much money will you have in 1 year? This is future value amount. How much will you have in 2 years? Right? So same formula, just a couple different extra numbers in there if you want to know for 2 years. So the answer at the end of 1 year, you'll have 1,050. Well, why 1,050? Because you take your principal amount, which is 1,000, and you multiply it by 1 times, or I'm sorry, 1 plus 0.05, right? 0.05 is 5% in decimal form. So you basically have, in easier format, 1,000 times 1.05. And 1,000 times 1.05 is 1,050. At the end of 2 years, you will have 1,000 times 1.05 to the second power, right? Which basically means that 1,000 times 1.05 times 1.05. And when you multiply that out, whether you do it with using your power function, or if you use it 1,000 times 1.05 and the product of that times 1.05, either way you will come up with $1,102.50. So what is the future value formula used in the previous example? All right, so where's the formula? Because you need to look at the formula, write it down, pay attention to it, memorize it, whatever you need to do. So when it comes to the quiz or to the test, and I'll definitely say there are questions regarding this on the quiz, you'll have it right there. You know it, you understand it, and it'll be a breeze. Right? So F equals P times 1 plus R, and then the N on the outside just represents the amount of years. So FN, amount received in years in the future, right? So that's how much you end up receiving. And P is present value of the amount, right? So that would be the $1,000. That's the present value. F is a future value. R is the annual interest rate, right? So that's why we had 1 plus 0.05 because it's 5%. And then n is the number of years in the future, right? So that n, if you see it right there, right, that n right there is how many years. So if it's not just, if it's 5 years or something, then the 5 goes there. And then that basically means, for example, 1.05 times 1.05 times 1.05 times 1.05 times 1.05. So how does the future value concept relate to the present value? So future value is valuing something in the future given an investment today. Present value is the value of future cash flows measured in today's dollars. So now we're going the reverse. For capital budgeting, the value of future cash flows must be valued in today's dollars. The present value formula is derived from the future value formula, right? Just move some numbers and letters around, and stated as the following: P equals F divided by 1 plus R n. So instead of multiplying, now we're working with division. And when you see this this very visual diagram of it, you should understand it. So present value example: if you receive 1,102.50 in 2 years, how much is that worth today in dollars, assuming that an interest rate of 5% is what remains, right? So you have your present value, right? And you don't know what your present value is, but you have your future value, which is 1,102.50. So what's our formula? Well, our formula, like I said, just move a few things around. P equals F divided by 1 plus R to the nth power. So remember P, what do we have? That 1,102.50, because that's, we know, our future amount, divided by 1.05. And how many years did we say we were speaking about? We were speaking about 2 years, right? So then the 2 goes there. So that's 1,102.50 divided by 1.05 times 1.05, which ends up being 1,000. So how can we use tables to calculate present value amounts? Well, took you through the long way, but at the end of your chapter, there are some tables that you can go to and just get these amounts. Although most managers use spreadsheets such as Excel to perform and present value calculations, you can also use the present value tables in the appendix in chapter 8. The first table of the appendix provides the present value of $1 given the number of years and the interest rate. Right, comes in very, very handy. If that's a page that you have on an ebook or whatever, print that one, copy that one, whatever you need to do. If you have the textbook, definitely highlight it. So how do we use the first table to calculate the present value of future cash flows? Well, let's assume $500 will be received 4 years from today, right? So I'm going to get $500 4 years from today. What is the present value of this cash flow at 10% interest, right? So how much is it worth at 10% interest? So find the present value factor amount in the first table, where n equals 4, right? So 4 n meaning the years, and then R, which is what's the percent, right? So what's your rate, is 10%. So you just look at those and you go through, you have your 4 years and you have your 10%, and you come up with that amount of 0.6830. So I want you guys, maybe pause the video, go to your book, and go back there and see if you can get it. It's the first table, not the second one, right? So see if you can match up 4 years and 10% and see if you come up with 0.6830. So present value equals the amount received in the future times the present value factor, right? So if you have $500 times that 0.6830, you come up with 341.50. So the present value is 341.50. You get $500 4 years from now at 10%, it is worth $341.50. That is the actual present value. So notice that we present value 341.50, or your present value is 341.50, is less than the future value of $500, right? Because the time value of money premise, $1 received today, is worth more than $1 received in the future, and that always holds true. So you want to evaluate investments using the net present value approach, right? So we'll go through the net present value approach, and we'll also go through the internal rate of return. So what is the net present value method? So net present value is used to evaluate long-term investments, right? With this whole chapter, we're talking about long-term, not short-term investments. Net present value is calculated as the present value of all future cash inflows minus the present value of all future cash outflows, right? So cash coming in versus cash coming out, and what's our difference but in the future. If the resulting net present value is a positive, accept the investment. If not, reject the investment. So pretty, cut and dry. Hey, if it's positive, then accept it. If it's negative, then go ahead and reject it. So what are the three types of the net present value method? Or what are the three steps? So step one, identify the amount and timing of each cash flow required over the life of the investment, right? So we need the amount, we need the timing of it. Step two, establish an appropriate interest rate to be used for evaluating the investment. Let's say I need 5 or 10% back. And then calculate and evaluate the net present value of the investment. So here's an example. So we'll assume Jackson's Quality Copies, is considering purchasing a new copy machine, just like the story at the very beginning of Chapter 8. The company will pay $50,000 for the new copier. I used to work for a copier company. Yes, they definitely cost that much. So $50,000 for the new copier, and the copier will last for 7 years. So the annual maintenance cost will be $1,000 per year. So one, we're paying $50,000 for the copier, and we're paying $1,000 a year for maintenance costs. So you have to cut that $1,000 between the 12 months. So labor cost savings will be $11,000 a year. So that's in a positive. We did our equation and found out, oh, we're going to save $11,000 a year. And further down along the chapter, what we look at is how soon before we make the money on an investment back. And the company will sell the copier for $5,000 at the end of 7 years. So it has a salvage value. You can go ahead and sell it, and you get that $7,000 back, or $5,000. I'm sorry, for 7 years. So let's go through the actual steps. Step one, identify the amount and timing of the cash flows required over the life of the investment. So we deal with today. Purchase price is $50,000. We're $50,000 in a negative because we haven't had any time to earn back our money. But year one, right, there's no purchase price from year one to year 6 because we purchased it up front. The maintenance cost, like I said, is going to be $1,000. That's a negative, but we're going to save $11,000 on labor savings, right? So in essence, we're going to make $10,000 a year. So we have $50,000 that's been spent, right? And then we're going to make $10,000 a year. So if we're looking like at our payback period, we say 1, 2, 3, 4. After I'm sorry, 5. After 5 years and getting a net of $10,000, we will have made up for our investment. And then anything past that, right? This year 6, year 7 is going to be cash and revenue for the company. So cash flow for copy machine investment by Jackson's Quality Copies. All right, so step two, establish an appropriate interest rate to be used for evaluating the investment. Like how much, do I need to make back? What's my interest rate? So the interest rate is typically based on the organization's cost of capital. The cost of capital is weighted average cost associated with the debt and equity used to fund long-term investments. The general rule is the higher the risk of the investment, the higher the interest rate would be used in the net present value analysis. So the interest rate is also called the required rate of return. And that goes very in detail a little bit later in the chapter. So calculate and evaluate the net present value of the investment, right? So if you have that $50,000 that was initially spent, and then every year we're going to make $10,000, but we have to look at that present value factor, right? So when we look at it, $50,000 is whole, so it's 1.000000, right? So that just means we come out with that actual same number. So then we go to our initial $10,000, and what do we say? We say 10% at 1 year, and we use our table, right? And you should come up with this number, 0.9091. And then when you go to 2 years at 10%, you should get that. And these should be decreasing down the line. They should not necessarily increase, right? So hopefully, let me just go over that again. Hopefully that makes sense to everybody. So $50,000 is the purchase price, $1,000 every month for maintenance, but we're making as a company $11,000 back. So after that 1, 2, 3, 4, 5 years, we've actually because we're going to net $10,000, we've actually made our money back. Now you may be saying, hey, Demetrius, well, wait a minute, we can't wait 5 years to make our money back. Well, when it's a big capital decision, yeah, you can't wait that long. So you're going to get these from the table, right? So you take your 10,000, multiply it by that, then you have your present value down there. You add those up, you get 1,250, and that means it's going to be a go. So stay tuned for lecture part 2, and we'll go forward from there.